Let me explain the overall strategy and what we do. We're trading the 0 DTE event on options on the S&P derivatives. So we'll trade options on the SPX, the E-mini S&P futures, and also the mini SPX, which is called the XSP. And also I'll add in there the NASDAQ index, the NDX. So we have all four of those things that we trade options on the 0 DTE event. Now, our strategy involves two primary overall strategies or methods, and that is that we want to collect premium on the last day of expiration, because that's where premium is going to decay at its quickest rate until it goes to zero in the smallest time window possible. And we trade asymmetric risk to reward. In other words, we take very tiny risk and we're looking for outsized rewards, typically as a minimum of 1 part risk to 9 parts reward. And quite often we'll trade 1 part risk to say 12 or 15 or 20 parts reward, 1 to 20 trade. Now I know that most people trade options. They're putting on iron condors generally for a 0 DT event, and they trade something very different where they'll take 10 times the risk for 1 part reward. So in other words, they'll put up $1,000 to make $100. And they're not just going after that 100, they're going after only half of that 100. So it's really a 20 to 1 risk to reward, where we are potentially a 1 to 20 risk to reward. You can see there that it is clearly 2 or 3 magnitudes of greater efficiency the way we trade. So anyways, that's the overall strategy, and that's how we trade. And the way we achieve these trades is by putting on out-of-the-money butterflies. So what that really means is that we're treating the butterfly as a directional instrument in some cases. In other cases, we look at the market from an agnostic position, and we put a butterfly on one side, on the plus side or the bullish side, and a butterfly on the bearish side. So those are the two primary ways we do it: market agnostic and then trending. So there you go. There's the universe of what we do on how we attack 0 DTE. Now, when I first started this service a little over 2 years ago, the question was, well, how far out of the money do we put it, and how wide do we make the butterfly? Now, we use the butterfly because it allows us to create that risk to reward. And at the very outset of this strategy and the exploration of what worked and what didn't, I would make the proclamation that we can put on these, but we never want to have a risk to reward that's less than 1 to 5. Now, sometimes I put on a 1 to 3, 1 to 2, 1 to 7, 1 to 15, whatever. And I did that for almost 2 years. And I came up with all kinds of results, all of them positive. And then after reviewing and analyzing all the results, I wanted to see where I was getting my greatest return and where should I be putting most of my effort. Should it be putting it in at a certain risk to reward or a certain width or some combination of the two? What worked the best? Now, also the other intricacy or nuance to this is, which way do we go? Do we trade a single fly or do we trade the double fly, which I call the Batman? Because when you look at the at expiration, the 2 flies, it kind of looks like Batman's ears. That's the trade that we're going to be putting on most often. The reason for that is that we really, most of the time, have no idea which way the market's going. We shouldn't pretend. There are some cases like in the 2020 market or 2021 where the market just went straight up and it just made a lot more sense to go with the trend and trade the singular fly.